Let's pretend you have just been picked to run a small island nation. Congratulations, but don't settle into your throne quite yet. A potential catastrophe looms on the horizon. A huge tsunami is coming your way. Fortunately, there's hope. Yours is a wealthy island. You can't prevent the tsunami, but you can prepare your people for the onslaught, and perhaps even mitigate its worst effects. So you make an executive decision. The island will use a huge share of future income to equip each resident with the best known defense against tsunamis. Every islander gets a parachute. Wait, how would that work? The above situation exactly describes the puzzlement among some people in Silicon Valley at the $1.5 trillion Republican tax bill that was approved by the House and Senate this week. To those who study how tech is altering society and the economy, the bill looks like the wrong fix for the wrong problem. The bill, the parachute, does little to address the tech-abetted wave of economic displacement, the tsunami, that may be looming just off the horizon. And it also seems to intensify some of the structural problems in the tech business, including its increasing domination by five giants: Apple, Amazon, Microsoft, Facebook and Alphabet, Google's parent company, which owns some of the world's most important economic platforms. These giants will see immediate and broad benefits from the tax bill. Multinational corporations with a lot of money parked offshore, Apple, Microsoft and Alphabet collectively hold about $500 billion in cash, get a windfall from the bill. Under the new plan, offshore cash will be taxed at a one-time rate of 15.5%, a substantial break from the 35% the companies would have had to pay if they'd brought the money back to the United States under current law. There has been some debate about whether the bill might actually hurt tech giants in the long run, because it introduces a 10.5% tax on future foreign profits, thus reducing some of the benefits of the offshore accounting wizardry these companies have engaged in over the last decade. But Gabriel Zuckmer, who studies taxes and inequality at the University of California, Berkeley, pointed out that the 10.5% rate would still be much lower than the rate paid by potential startup rivals that mostly make their money in the United States. The corporate tax rate on domestic earnings in the new bill is 21%. This difference, Mr. Zuckmer said, creates an uneven playing field, where big monopolies will pay lower taxes than new entrants, which could reduce innovation. Apple, Google and Microsoft, which, like other large businesses, significantly expanded their lobbying efforts to push for tax reform, declined to discuss the effects of the bill. But some in Silicon Valley think the giants misplayed their hand in the legislation. In pursuing short-term tax advantages, they missed a chance to advocate policies that might have more broadly benefited many of their customers, and improved their images, too. Silicon Valley's failure to engage in the tax reform debate was a serious failing of long-term strategy, said Greg Forrester, a writer and researcher who studies economic and social issues related to the tech business.